We've seen that prior to 2006, over the last 10 years before 2006, there was an unprecedented rise in the housing markets in the US. By the second half of 2006, the housing prices have peaked. And over 14 million new mortgages have originated 5 years before the peak period. And the total amount of outstanding mortgages was it crossed 10 trillion US dollars. And if you look at 10 trillion US dollars, to give you some perspective, is that the GDP of 2007 was $13.8 trillion. That was an astronomical number that we've seen. And that number increased, actually doubled over the 5 years before the 2006. And the subprime mortgages at that point in time, those about 20% of this was actually the subprime mortgages. And what the financial institutions have done is that they quickly pull them together and securitize them and sell them to investors like you and me. So by the end of 2006, you see that the prices have started to decline and more sales have weakened. And at the early 2007, we have witnessed the significant increases in defaults and foreclosures, and a number of smaller financial institutions had already started to file for bankruptcy. At present, if you look at the numbers, the home foreclosures have reached an enormous number at an annual rate of 2.5 million homes. And if the estimate was correct, I've last seen it was 50 million homes have no equity placed in their homes, which means that a large number of these homes were bought with less than 20% down payment. And if you look at those numbers, all those, mainly the metropolitan home values have dropped by more than 20% value, which means that you'll be expecting to see more of these foreclosures in the next, in these coming months and years. By summer 2007, the crisis had already spread to the larger financial system. With the emergence of the general credit and liquidity crunch, we've seen a lot of transactions in derivatives have collapsed, and the loans, the market for loans have disappeared in those, the very beginning of last year. And we have also seen that the first victim, the large financial banking system, investment bank has collapsed, was Bear Stearns in March of 2008. And the stocks of Fannie and Freddie Mac have plummeted about 80%, more than 80% of the value. So last month we've seen that the Lehman Brothers have also collapsed. So the crisis is no longer a US crisis. We've seen that it is, in fact, the world crisis. So the questions we're going to have is the depression fears. Very often one remarks, you look at the newspapers on a daily basis, it is the worst financial crisis the world has witnessed since the Great Depression. Then an obvious question one will ask is, are we near the types of economic difficulties that were faced in the times of the Great Depression between 1929 and 1933? What I'm going to do is to give you some perspective and see whether we are even near to that times of the economic crisis then. The US economy today and during the Great Depression, if you've seen some of the key statistics, for example, here I personally believe that the US economy is much stronger today than it was in 1929. And the fundamentals are still pretty strong, regardless of the economic crisis we are facing at this point in time. The GDP, for example, now is about 1%, and I'm sure it's going to fall, but it is nothing compared to negative 27% in the Great Depression period. And the unemployment rate, the new number came out, was 6.1%. In the Great Depression period, we are looking at 25%. And the US exports today, about the last year, was about 24% compared to minus or negative 66% in the 1929 to 1933 period. And if you look at the federal deficit as a percentage of GDP, it is now currently 4.9% as opposed to 1.4% in the Great Depression period. Given the large number of 4.9%, we knew that at the last figure that came out last week, I think a few days ago, it was 455 billion US dollars that's the current federal budget deficit. It is an enormous number, but then today's market is very different from it was in the Great Depression period. where you see that there is a greater linkage between the fiscal policies and the economy as it was in the times of the Great Depression. So I do not think that we are even near to the economic difficulties that we or the people faced in the 1929 and 1933. Okay, let me just sort of give you a quick insight. What have been done so far is that we've seen a global concerted efforts that were taken by all the major policy makers. The first thing they need to do is to put in the market, bank recapitalization that has been done, initiated by the UK bank, and the guarantee of deposits or loans, especially interbank lending to install. Most importantly is to remove fears among investors, to restore confidence and trust in the banking system. And I will discuss various other points that I have, but I would like to sort of pass it on to Suman, who has his 5 minutes as well. Thank you.
Hello. Thank you. Thank you for lending me your ears. I'm Suman Banerjee. Thank you, Professor Singh, and thanks all of my other colleagues. I'm going to talk about, in broadly, what is it a little bit. Professor Singh has said it. And then I'm going to talk about what is the size of this problem loans that we are talking about. Then I'm going to talk about, I'm trying to relate that is the size the cause of this problem or something else. So as Professor Singh has said, it started from something called ninja loans. Loans given to people with low credit score, low credit worthiness, and with low down payment because they were unable to pay. The objective was very noble when it started. Objective is if you make people own houses, properties, you give them incentives to work hard and do well. So that was the objective of this policy. What the financial institutions did was take these loans, sliced and diced, and made it into securities like bonds. And they sold it to people. Again, the objective was perfectly correct. The objective was that, these are high-risk loans. If one individual holds these loans, there's a chance of a catastrophe happening to his future income. If you can spread it out among millions of people, there's a chance that all will lose something, but it might be that each individual will lose very little, and as a consequence, nothing, it will not hurt their future perspective, future economic perspective or their growth potentials. So the spreading out in economic sense is a perfect idea. What is the size of these ninja loans that we are talking about? If you think about it, even the best estimates that I have seen so far, turns out to be about $2.2 trillion. The recent data on default on housing loans says it's about 15% of these ninja loans are defaulting. So if we estimate, it turns out even the best estimate will give you a default amount of $400 billion, which is nothing for these financial institutions of the size we are talking about. Each institutions have 150, 160 billion dollar market capitalization, and we are talking about thousands of such institutions. So as far as the size is concerned, the size is not really big. But the problem lies in something called an investor's belief. Investors, financial market, as we have said, and Professor Singh has said, and Lillian has said, is a fairly complicated institution, financial institutions. We all don't understand or even try to understand the working of these institutions in details. We rely on something called trust and reputation. We believe that, Goldman Sachs, Lehman Brothers, Morgan Stanley are institutions, they have existed for hundreds of years, and they do things correctly. They can make mistakes, but there won't be any systematic mistake, any large-scale mistakes they won't do. This is the common belief under which we investors work.